So in this last session of this class, I want to get into the regulatory side. I know you hear regulation, you think, oh, how boring, but actually on the property and casualty side, this is huge. We've seen a little bit of this when we're talking about credit scores and the mold issue and storm surge. Insurance is a heavily regulated industry, especially the auto insurance, maybe auto and homeowners. It's amazing to me that auto and home are much more regulated than life insurance, because life insurance is really where some of the most egregious actions are. But because auto insurance is required, a lot of states require people to buy at least liability coverage. And given that homeowners insurance is often required if you have a mortgage, because it's required, it tends to be a little more politically sensitive. So I want to walk through this article by David Cummins and Mary Weiss. I don't know Mary Weiss, but David Cummins is extremely well known in the actuarial world. It's an old article, very old article. I wish I could update the numbers for you, but everything they say in this article is still true today. This hasn't changed any. I was going to show you in the class what the numbers look like more recently, but with the inability to get on campus and use the Blackboard, use the Bloomberg machines to get the data, I can't really show you updated numbers. I will, and probably in a future class. We have 2 more classes after this one. I might show you numbers that are a year old from what I did last year, to at least get some sense. Obviously this summer is going to be radically different given what's going on, but the concepts in this article are not radically different. The numbers have definitely changed. And so so you can see back between 84 and 89. So this is 3 decades ago. It's quite a lengthy time ago, 3.5 decades ago. So auto insurance rates were rising dramatically versus overall insurance rates were rising. Overall inflation was rising only 3.5%. So why were auto insurance rates going up so much more? So what's changed in the last 10 years, 15, 20 years? Auto insurance has become much more competitive, especially with Geico and Progressive becoming much more aggressive in their advertising and in their pricing. But there's a lot of conflict about our auto insurance companies overcharging for a product that the state requires people to buy. So in certain states, and we're going to talk about this market disruption, market meltdown, for some drivers in some states, their auto insurance rates were almost as high as the value of the car. They're essentially buying the car twice. Once they're buying the car through their banker, and the other they're paying the exact same amount again for the insurance. Now they say they're writing this article to ask what went wrong with auto insurance and what can be done to solve it. They don't actually do that in this article. What they're really doing in this article is asking, is regulation helpful or harmful to the consumer? So look at it as a bigger question from that standpoint. And auto insurance has been a hot debate in a lot of states. It's become a very major political issue in the last 30 years. And a lot of consumer groups say auto insurance is expensive because the industries are inefficient, that there's anti-competitive practices, firms have monopoly power, or firms are just really lax in their settlement practices. All right, so these all contradict, at least the first and the third one contradict any understanding of basic economics. Obviously, if a firm could try harder to get their expenses down or to pay lower in claims, that their profit would go up, or their prices could come down to be more competitive. It doesn't make sense. The anti-competitive side, just think about it yourself. What I find with most consumers is not that auto insurance is anti-competitive as much as most insurance and most policyholders never shop around. A lot of people, the auto insurance they have is the auto insurance their parents had, and they just continued it. I try to shop insurance at least every 5 years. Life insurance, you should definitely do the same thing. Homeowners is not that big of a deal for me, but for some people it's a big issue. But auto insurance, you should definitely reprice your auto insurance every 5 years. The nice thing is you don't have to call that many companies. Allstate, USAA, Geico, Progressive, State Farm. There's 5 companies right there, and they all know what each other is charging. They are, I think, very competitive between each other. But you should ask. And what I think is real important is actuaries at different companies have very different opinions. So Bexar County tends to be a high auto insurance rate place, and that's because Bexar County has a high auto theft. So if you live 3 inches outside of Bexar County, supposedly your auto rates will drop dramatically, but not every insurance company has the same view of that. And so you might find USAA is more expensive than Geico because the USAA actuaries have a different view of Bexar County versus the Geico. But whatever, every firm has to file their rates and they have to justify why they're charging one group more than another. But the anti-competitive, I just don't see it. Just because I feel comfortable if I shop around, it's I know these guys are competing with each other. I know they're fighting, but it is something to look at. In certain jurisdictions, there could be an argument that there are not enough insurers. Certain places like in Hawaii, where there just aren't that many insurance companies, it's possible if there's only 2 major insurers that they're somehow doing some kind of pricing that's gouging their customers, but I doubt that one. In fact, so I essentially doubt all 3 of these. But anytime consumer groups start complaining, these are the things they're going to come up with. But that's what argues for regulation. We need regulation so that companies don't just pass their big expenses, these big parties, pass them on to their customers, that they don't fix their prices between them, and they don't just pay claims to save themselves time and energy. They'll just pay whatever claim comes up, and they'll just pass it on to the consumer. So California Prop 103, we've talked about that a little bit before, maybe in another class, so you may not have seen it in this class yet, but California Prop 103, major issue for the industry. It required insurance companies to roll back their premiums 20%. And it reestablished really strong regulation in the state. And they had an elected insurance commissioner, which anytime you have an elected insurance commissioner, their number one goal is to get insurance rates lower. Texas does not have an elected insurance commissioner, so in Texas, the insurance commissioner tends to be much more balanced between consumer groups and the industry. But in a state like California, where they elect their commissioner, that commissioner will definitely be an advocate for the consumer side. And what bothered the company I was at, this 20% rollback, was across the board. So you had a company like USAA that say, hey, we're already 20% lower than everybody else. We're 20% lower than the average. We shouldn't have to reduce our rates. And so that put a lot of companies into court. A lot of this was battled out in court, and there really wasn't a 20% rollback in rates because each company was fighting their own side of the argument. So really what this article is about is the role of regulation. And the bottom line is it helpful or is it harmful? Is it the solution to our problems, or is it actually the cause of greater problems? So insurance is one of the most heavily regulated industries in the economy, especially the property and casualty side. The downside with the property and casualty side is that each state has their own rules. Some states are a piece of cake and no problem, and some states are almost impossible, like California. Very difficult to price insurance in those states. So regulation can help in some cases, and it can make things worse. We are a free market economy, so regulation should only step down when free markets are not working, where there's some non-competitive force going on, some monopoly force or something that's causing companies to get greater than market rates. They're essentially getting above required returns because there's no competition to push prices down. So regulators step in and say, hey, if the market's not competitive, we'll force companies to provide competitive rates. Rate regulation stipulates that rates, and we've talked about this before, this is really, really critical. We talked about this a little bit, not all 3 of them, but definitely talked about it with the credit scoring. So rates should not be excessive, they should not be inadequate, and they shouldn't be unfairly discriminatory. So we talked about that unfairly discriminatory in the credit scoring discussion. You can't discriminate based on race, religion, ethnicity. You can discriminate based on age. You can discriminate based on gender, the type of car, where people live. There are things that do allow. So unfairly gets back to that credit scoring. Unfair would be either Remember the two categories that were illegal: unfair because there's no actuarial basis for the difference in pricing, or it hits one of those protected groups: religion, ethnicity, race. So that's unfair discrimination. You notice the other two almost contradict each other. They shouldn't be excessive, but they also shouldn't be inadequate. And I can tell you right now, in most states that have, especially those with elected commissioners, they've almost completely forgot about inadequate, and they're almost entirely focused on excessive. Inadequate means firms coming in and lowballing their rates in order to get market share, when if they're wrong, they'll just go out of business and move somewhere else. Regulators are supposed to keep companies from undercharging for their rates. Remember, the state of Texas had a band. As long as you're within the band, so the band might be 50%. As long as it's within that band, you can charge any rate you want. So the lower end of the band tells you, hey, you can't charge less than that because your rates would be inadequate. You can't charge more than that range, or you'd be excessive. Most states require prior approval. Some states are a piece of cake. Some states are really, really difficult. And again, I went through this process. It was very interesting to me. I had to write letters, do analysis. States like Florida, Georgia, Washington, Hawaii, California, very difficult states. And a lot of times they would reject what we sent and just send it back, and you'd go back and forth several times. I think that's the downside of being a pricing actuary, is having to deal with the rate regulations of each state. It really is a pain. You would know your states extremely well and what the regulators would allow and won't allow. It's a little bit of a bureaucratic game companies have to pay. So insurance inflation started to be an issue in the 60s and 70s, and that's when rate regulation became more seen. One thing they started doing in the 80s, 70s, and 80s when interest rates got really high is regulators requiring companies to incorporate investment income into the rate making. So we talked about that as being float, that investment income you make on the float needs to be passed on to policyholders. I remember USAA got a new CEO. I might have told you all about this earlier, but I can't remember. We got a new CEO. He came from the banking side, and he was adamant that the investment income of our property and casualty company was not their money. That was USAA's money. We could do with as we liked. And I remember in a meeting pointing out to him that that can be your theory, but the regulators do not allow you to do that. Regulators require you to pass that investment income back to your policyholders. And boy, he slammed his fist down on the table. He was so mad. The CFO of the property and casualty company is sitting right next to me, a good friend of mine, my first boss at USAA. He says, "Is that true?" And she said, "Yep, that's true, sorry." And he was so livid about that. But to me, it almost doesn't matter, because if interest rates are 16, 17%, and USA is making all that money, and our competitors are cutting their rates because they're making so much money on investments, USA would have no choice but to cut its rates to be competitive. So the competitive environment is going to essentially force you to do that. But again, that's the whole idea of float. We've already covered that. There can be a lot of time between the time you collect a premium and settle a loss. During that period, you have float, you have reserves. And so in the 60s and 70s, regulators started requiring companies to specifically earmark that investment income as belonging to their policyholders. Anything you have in reserves, any investment income you make on that, you've got to pass that on to your policyholders. Half the states regulate auto insurance rates. They require prior approval for rate changes. Some states don't require prior approval, but they do require prior submission. You have to submit your rates to the states, and then they can come back and question them if they don't like them. You do have to be competitive. Most states, they don't want anti-competitive. So research has found that, okay, so here's the key. Is regulation working? So the first statement says, yeah, it looks like it's working. Research has found that premium rates tend to decline after rate regulation, and it's finding that regulation tends to depress premiums. So auto insurance prices tend to be lower in regulated states than competitive states. So does that mean that it's working, or is there something else going on here? And I think the answer is both. Regulators probably are taking advantage of some states where there is maybe some anti-competitiveness, and they probably are bringing rates down. In other places, insurance companies are offsetting those lower rates by essentially giving a worse product to the customer. So some say, hey, that's proof that this industry is not competitive. Others say that the markets are competitive, and so what the state is doing is forcing them to charge prices that are inappropriate and are too low, and not allowing them to earn a fair profit. And so here's what the insurance, this is the word the insurance industry always uses. We saw this with credit scoring. They say, you don't let us charge the rates we should charge, then you are going to see a serious issue with availability. We are going to cut back on our worst customers. They're going to come to you and complain, and they're not going to have any place to go to buy their policies. And we're definitely seeing that in states like Massachusetts and New Jersey. We'll talk about some of these states where the entire state freezes. There are some states, I think Massachusetts we'll see here in a little bit, where over 50% of the market is going into these assigned risk pools. These drivers who can't get insurance because the insurance industry had just refused to sell anymore, availability goes down, they have to go to the state and be assigned to the insurance industry. The insurance industry starts losing even more money, and they just start leaving markets, and availability becomes an issue. We'll talk about a total and complete market meltdown where the entire industry stops functioning. So we have to worry about antitrust. States worry about antitrust just as much as the federal government does, but remember with insurance, or we'll see this with insurance, insurance is regulated by the state because of McCarran-Ferguson. We'll get into that a little bit later. Hopefully we'll have a little time to at least introduce you to this law because it's extremely important. So since states regulate antitrust and not the federal government, that's the unique thing about insurance. The federal government, when it comes to banking and other businesses, both the state and the federal government regulate antitrust. But with insurance, only the state regulates antitrust. But states do have really strong antitrust regulation. So we'll look at it. Is this industry involved in antitrust? Can insurers get together, pool data, and cooperate on the ratings? I'll say every time I've been in a meeting with actuaries from different companies, and you know, you'll see this if any of y'all could have gone to the Insurance Council of Texas Insurance Symposium this summer. The first thing they'll say in that symposium is, we are not discussing rates in this meeting. I've been in meetings at USAA where 2 or 3 companies get together, and the first thing they do is say, we are not talking about our insurance rates. So they're very sensitive about that. So there's not any appearance whatsoever that there's any cooperative rate making between companies. Insurance regulators used to be focused on regulation. That's that term we had up here above on rates not being inadequate. For most of the history of regulation, it was on the inadequate side, making sure companies don't charge so little that they have the risk of going insolvent. So regulators need to protect policyholders from this, because essentially if the company goes under, the stockholders, the most they lose is what they invested. The policyholder is going to lose a lot more than that, right? They paid $300 for insurance, but they may have a $50,000 claim coming in, but the company goes under. They can lose a lot more. The state loses out because the state will often step in when the insurance company goes under. That's what these guaranteed pools are. So the state does have some interest in the fact that they're backstopping insurance companies if they go insolvent. Insurers certainly have a rationale for regulating the inadequacy of rates to make sure insolvency doesn't happen. But rate regulation has tended to ignore this side of regulation and has focused more on the rates not being excessive. So is there anti-competitiveness in this industry? A regulatory goal in insurance rating systems is the requirement that the rates not be unfairly discriminatory. You can't charge differential rates if they're not justified by cost. The goal of equity interaction with that of affordability. So equity and affordability interact with each other, because you might have people that are charged a lot because they really are horrible drivers, but they're getting charged so much they can't afford insurance and they can no longer live their lives. So states have to somehow balance these two things. So it's people who don't like this industry. One, they say their cost-based ratings are inaccurate. Now, we talked about that with the credit scoring. Is it inaccurate? I don't believe that, but y'all know I'm a big fan of actuaries. They tend to be purists when it comes to math, and I think they know their math better than any political consumer group complaining. That's just my opinion. I certainly have a bias there, and I could be absolutely wrong. Others point out there's a lot of overlap between the different risk groups. We saw that with credit scoring as well. Is credit scoring just piling on to charge poor young drivers more? So could you have, a good driver who's getting charged more? And so we talked about telematics. Maybe that's the solution to that. Some rate classes are said to be over heterogeneous. So yeah, there's all these complaints. We saw a lot of that when we talked about credit scoring. So essentially what they're saying is there's no, we're harming really good drivers that are just in the wrong rate class. Insurers need to get better at that. They either need to have more rate classes or fewer rate classes. The opponents are going both directions here. Some even say, hey, this is just unfair. Let's just charge everybody the same. So we'll talk in a little bit why that does not work with insurance. It's actually quite disastrous. And we talked about that with credit scoring. You do that with credit scoring, everybody can't win. If you do that with credit scoring and you say you can't use credit scoring, then people with good credit scores are going to pay 40, 50% more for insurance, but then people with bad credit scores will pay less. There's always going to be someone that's harmed when you say you're going to flatten the rates. So what do you do? With urban drivers, they pay more. Some of them are in poor areas that are high crime, so they pay even more. What do we do with this? How do you have low-cost drivers end up subsidizing high-risk drivers? Is that fair? That's what Proposition 103 did, is it required insurance companies not to charge more to city drivers than to rural drivers. And when that election went into place, city drivers voted for it 98%. Rural drivers voted against it 98%, because rural drivers knew that was going to greatly increase their auto insurance. High-risk drivers are subsidized to some extent, so the question is how much should they be subsidized? Because the more you subsidize them, the more likely they are to buy more insurance than they need, and more likely the good drivers are to buy less insurance than they need, and that's that spiraling issue. We're going to talk about this. So resulting in price spiral and market failure, because bad drivers overbuy insurance, good drivers underbuy insurance, and each cycle, it gets worse and worse and worse. So I'll mention New Jersey, Massachusetts. We'll talk some about them. All right, so let's stop it there, and I'll finish up this article in the next class. And then we just have a little bit more on regulation, and then I want to, only have 2 more classes left, so I want to spend one class just touching on regulation. The last part of the class was on the legal aspect of insurance, and we can skip that. I might do that more in my life insurance class. It just depends. You can read through those notes, and I think they're self-explanatory, especially if you took a really good business law class. But there's a little bit more on regulation I do want to cover. We'll finish this article, do a little bit more on regulation, and then we might spend at least portion of the last class, maybe in a live stream, going over the exam review.